Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Anastassia Juventin, who's a portfolio manager of hedge funds and alternative strategies at AMP Capital. Anastassia, welcome.
Hi, Alex. Thanks for having me.
No problem. So I thought for you today, we would start off with your role at AMP. I know AMP has been going under a little bit of a restructure within its hedge funds and alternative space. You've been there now 2 years. If you could maybe give us a bit of a background of sort of what you've been doing as part of this restructure.
Right. Yeah. So I did join AMP Capital 2 years ago, actually 2 years to the date almost. And when I started there, given my background previously managing alternatives in New Zealand for BT, there I was just asked to maybe have a look at the program that we had. I didn't start as a restructure because if anyone's done a restructure, they know it's not a lot of fun, and you need to really weigh up the cost of it and the benefits of it. So we just started looking at what allocations we had across the hedge fund and other alternative strategies, and just tried to test our objectives for the program and make sure that still was the right thing to pursue for our clients, and then sort of really just consider holistically what we needed from the hedge fund book in particular. Mm-hmm. So, the hedge fund sector itself has gone through a large amount of changes over the last, recent past, and we just wanted to make sure that whatever we were getting out of it was still appropriate for our clients. So that's how it started, more of a holistic look, using a pair of fresh eyes. We looked at the ways of, how to best implement and structure the program as well. And for us, it made sense to make some changes to the portfolio. So what we essentially are doing as we speak, we're in the middle of the transition. So I can't really talk to the names of the managers or anything like that. But after retesting our objectives for the book and our conviction in maintaining the program, we looked at the ways to implement it and structure it. And it made sense from the client perspective to move into more of a custom-based approach, which is, as I just mentioned, we're currently doing.
As you look into the portfolio, that portfolio is made up of a number of names, a number of different strategies. What are you trying to sort of get? You've got an objective there. What are you looking for to try and maybe optimize for in terms of efficiency?
Just for the point of reference, I guess for AMP Capital, this is not a standalone fund, so you can't just buy my fund. It's more of a completion. It's more of part of the diversified portfolios. So for me, it's really important that in this part of the allocation, we're just not doubling up on some of those sources of return that we can get elsewhere. In the past, we invested through a large hedge fund or fund program, and I'm not saying there's anything wrong with that structure. It just for us, and taking consideration to the fact that it is part of the diversified portfolio, wanted to optimize in terms of the additional sources of returns that we are adding there. And I guess from a client standpoint, you really don't want to have a doubling up exposure to the same sources of return. So given that we look at the hedge fund book as part of the diversified bucket, diversified allocation, we optimize in terms of making sure that we add capacity in terms of those return sources that we access. And that's kind of briefly. What we're doing also as part of this restructure to enhance the idiosyncratic of those return streams is we actually introduce co-investments. And historically, the co-investments, have been allocated to, custom funds or dedicated co-investment vehicles. So we carved out an allocation within this book to co-investments. Those deals are sourced from hedge fund, managers, and usually, they vary across industries and geography. We've had a partner manager to do the underwriting process and, the research and due diligence, obviously, on those deals. But basically, adding those co-investment opportunities just adds to the breadth of the universe. and as those quite differentiated sources of returns funds, which we're quite excited about.
The co-investment is really interesting for this particular part of the market. We always hear about co-investments in infrastructure and private equity, but less so alongside hedge funds. What's the premise or the backdrop that you're looking for as you're doing co-investment in the hedge fund? Is it setting a mandate and then getting them to work within that? Is it around sharing IP? What does that partnership look like, or that co-investment?
So the way, and I know there's multiple ways to introduce that. For us, as the first step, so I've mentioned that we hired an advisor or a manager partner, as I like to refer to them, who will be managing effectively this new custom allocation to hedge funds for us. And as part of that custom allocation to hedge funds, co-investments is about a third, or a dedicated weight to that is about a third. So we worked with this, manager or partner manager, as I like to refer to them, to set up guidelines and constraints in terms of the co-investment deals that we will be willing to take. It will be done case by case. So we're not locking up and going into a fund of co-investment deals. These co-investments will be specific to our constraints. Some of those constraints will be around liquidity and exit time. And so what the partner manager does is they have access to a large community of hedge funds and can really do thorough due diligence, look at the exit options, also obviously look at, tax, legal, and other regulatory considerations around the co-investment deals, which makes the process a little bit easier for us. So this is the first foray into the co-investments with hedge funds for us. Going forward, that might change in terms of how we implement it. In terms of the nature of deals, we so far only added one, and as I've mentioned, we're still, going through this transition. Transition will be finalized at the end of this year, at which point I'll probably be able to speak a little bit more to who this hedge fund advisory partner manager is and sort of what exact strategies we're looking there. But in terms of the co-investment deals, we've added one in the equity space, basically strategies that are looking very attractive, but the manager can't have the full allocation in their flagship funds. So some of them would sit separately in our co-investment sleeve.
Is this fund, or I'm sort of cherry picking a little bit, but is this fund sort of focused purely on alpha, or is it some sort of unique alternate beta stream that you're looking for?
So when I talk about our hedge fund program that we're in the process of restructuring, I only refer to the hedge fund strategies, so being the alpha component. And I guess that's kind of good. It's kind of one of those things that I've mentioned before about the changes in the hedge fund space. I guess previously, if you talked about hedge fund, it was all considered to be alpha. But as we know, the last several years, we've started looking at really as alpha plus alternative risk premia, for example. So we do have allocation to alt risk premia elsewhere. But when I refer to hedge fund book restructure, I really talk about those alpha opportunities and thus the need to enhance the idiosyncrasy of return streams. And thus the need to reduce doubling up on some of the, say equity strategies, for example. Really needed to figure out if we needed, the long short equity manager. And I'm not saying we don't have any, but it was sort of a task to look at the whole portfolio on the diversified fund level and make sure that whatever we're adding is true alpha there, and it's not those strategies that are accessed elsewhere in the portfolio.
Is it fair to say that sort of part of the portfolio is partially defensive for the broader portfolio? So, you manage your book and it sits within a broader portfolio. Is this part of the portfolio mostly seen as defensive?
I find that I'm very cautious when I use the word defensive because people might interpret it differently. So, when you say defensive, what exactly do you mean? When I look at it, it sits in the diversified part of the portfolio. So by the nature of how we're constructing this and by the nature of the strategies that are going into it, and we've put very significant constraints on, correlation to equity markets, for example, and betas. But when you say defensive, it might naturally mean to some people that it holds or outperforms significantly or doesn't have a drawdown. I mean, I don't expect this part of the portfolio to never have a drawdown, but you can characterize it as defensive by the nature that it has, low volatility profile, for example, relative to equities. But once again, even low correlation doesn't mean no correlation. And I would not be surprised to see drawdowns in the book from time to time. It just the nature of drawdowns would be different. And I guess a lot of the time, the underlying reasons for that might differ as well.
Just to clear it up, I think that you're right. That was what I was thinking in terms of sort of the lower correlation, maybe sort of lower drawdowns, and maybe being sort of a little bit of a hedge in some place to some degree / market neutral in its thinking was what I was sort of trying to get at.
And I think given what we witnessed in March, the conversation around the hedges in the portfolio are quite topical at the moment. So in the hedge fund alpha portfolio, as I referred to it, that's being restructured at the moment, we don't necessarily have some of those tail hedging programs. Where they belong is still up for debate. My personal view, and not AMP Capital view, but just to make it clear, my personal view is that that's probably, in terms of the tail hedging, probably needs to be done on the total portfolio level. So while we refer to it as hedge funds, they're not necessarily there to hedge in terms of drawdown, if it makes any sense. Why it's diversified, once again, those strategies, I mean, if you look at, what hedge funds actually are, they're just, managers that have a greater flexibility to more traditional investments, right? And so they can implement different strategies. They're not as constrained in terms of the instruments that they use or geographies that they go to. So it's, they're mostly diversifying to a stock and bond portfolios. They have, lower variability of returns and lower sensitivity to movements in the stock market, but I don't see them as a hedge, as per se, in its true definition of a hedge.
I understand. So, in terms of the risk premia style part and the alternatives part of the book, how would you sort of characterize what's happening in that part of your portfolio?
Good question, Alex. I know that there's a lot of conversation to that extent, right? So I have a few ideas on that, and a few obviously spend a lot of time thinking about that. Well, if you look at 2019, in fact, that was one of the better years for the risk premium managers, and we've certainly seen some managers now in that part of the portfolio outperform. Then there were others that had underperformed to their objectives and continue to do so in 2020. I think it depends. AMP Capital allocated to alt-risk premium for a long time, so they've benefited from several strong years of performance in those strategies. This is our sort of, that allocation I view as our, beta of the absolute return allocation. So if I look at the hedge fund alpha, that's the true alpha allocation, and this is the beta being alternative beta, but nonetheless. I think the question is whether this is a structural change or just a cyclical change, and I still haven't made up my mind on that one. But what I would like to say is that we benefited from having a combination of managers in that part of the book. So as I've mentioned, we had some managers that performed really well last year, and that aided. So once again, diversification, not just across the strategies, but across the managers helped. Do I have conviction that this is still good diversifiers? Yes, I do. But we are working with our managers at the moment to just make sure that our objectives realign with, expected future outcomes. And another thing that I often talk about, and I talk about it openly with the managers in the space, is that I feel like in the past, some of the marketing around the strategies might have been a little bit too optimistic in terms of the drawdown profile of the strategies. I mean, this is something obviously that we can't solve with this discussion, but I definitely think that maybe some of the expectations that we as investors had for the strategies were overly optimistic. And then again, premia are also cyclical. So once again, is it a structural or cyclical issue? I guess we will have to wait and see. But we are looking and revisiting the strategies at the moment.
You mentioned about the diversification of managers in that risk premium type strategies. Are these is the situation that you have more managers looking at the same type of risk premium?
We do have managers that access the same premium, but they define it differently. So essentially, they have quite differentiated performance from what on the high level seems like the same premium. The devil is really in the detail here. And I think if you're looking at allocating to alt-risk premium, doing the extra level of due diligence is very important, and understanding the detail of how the premium are defined and how the premium are actually harvested, so how the manager implements strategy. I joined AMB Capital when they already had the allocation, so the due diligence has been done prior to me, but I'm definitely, as I'm becoming more familiar with this book, readdressed the due diligence and looked at all the little nuances. And as I mentioned, for us, it made sense to allocate to more than one manager in the space because of those differences. And in 2018 and 19, we did see those differences lead to the different outcomes, I should say, not add. So I think that's important. But I also think in that space, what's important is how much work the manager is doing at, research and development. Because really, it seems like you need to be running just to stay in one place in that space at the moment. So it's sort of the questions and things that I've been looking most recently across our managers in the space.
I'm curious, do you have a view on what's the biggest factor maybe in terms of dispersion of returns? Is it the definition of the factor, or is it the implementation and the rebalancing? Which part do you think is driving the return differential most of all?
It's a great question, Alex. I don't think I will be very successful at putting one ahead of the other. Unfortunately, I feel like they all really matter. Actually, everything that you said was on my mind as examples of factors that do matter. I've seen managers, not in this book, but through conversations with peers and consultants, I've seen that some managers that might, for example, look like they have high turnover because they rebalance more frequently, they might not be looked at because it optically makes it more costly. But in reality, you really need to understand the strategy and how those factors are defined, and look at explanation why those, for example, turnover numbers could look higher. So that's important. And I think the definition of factors is also very important. The trading costs are important, the implementation, the team, the depth of understanding, the depth of research that goes on. There's so much to look at. So due diligence is really, I can't express how important it becomes. And then the knowledge and understanding of the strategies then becomes really important when you go through periods of downturn. You really need to rely on understanding it to be able to figure out whether you're fully comfortable with the reasons and whether you understand why exactly the strategy is drawing down. Because I think what's worse is not necessarily the drawdown itself, because you could, as a long-term investor, you expect the strategy, and given this cyclical component to the premium, you expect it to have drawdowns from time to time, and that's fine. But what I think is scary part is if it's drawing down and you don't quite understand why it's doing that.
And one thing that I didn't hear you say, but I'm curious about, is sort of the impact of crowding in markets, where a lot of people are moving into the same strategy, a lot of people are moving out. How much do you sort of try to take that into consideration, or the market structure?
All very valid points, Alex. Crowding is one of those things that everyone is looking at, and it's so hard to define. So we have a few things that we look at in terms of the crowding, and a few measures that we get our managers to report to us quarterly, in terms of crowding and alpha decay in those strategies as well, which is the direct quoted result of crowding. But in essence, in the very high level, I think the strategies, without any doubt, did benefit from an inflow into this type of investments. So we had a large wave from 2016 onwards going into risk premium. Once again, it was seen as a cheaper liquid allocation to alternatives, and I can understand the appeal. How exactly the outflows would impact? Well, I would think that the impact will be, unfortunately, on the downside. But the flows also are really hard to estimate. We look at manager universe and flows there, but then there are like large sovereign wealth funds that do those strategies in-house. And how do you look at those flows? That's a very challenging question. But in fact, I recently had a conversation with someone about those flows, just basically how those are likely to impact IRP and other risk factors. And I think that maybe flows should be looked at as an indicator by the managers themselves. And I know some do and some don't, but it's one of those conversations that I'm also currently having with our managers, just in terms of how they can integrate that information, albeit that information might not be perfect.
You mentioned a little bit earlier about vol targets, as a target for particular managers. How important is that for you, for different managers, particularly as you sort of think about the market regime changing from sort of high volatility, then goes low volatility for a long time, then spikes up? How do you sort of think about vol as a objective as well?
That's a good question. And if we go back to our hedge fund book, when we were reviewing the objectives and setting the objectives for the custom mandate, we've set objectives around the net expected return that we want to deliver to our clients that invest in our diversified funds. And obviously with that came a certain volatility target of the total book. When we look at ultra-risk premium, we don't really have custom mandates there. So we invest with the manager's existing fund, where you have, sometimes you have and sometimes you don't. Where we invested, we had a choice of, flagship mandate with low volatility or a higher volatility. And often a high volatility in those strategies is seen to be additive to the performance, obviously. It's not shocking revelation. If you have a vol target of 12 to 15, you're exposing yourself to potentially a deeper drawdown, but you're also leveraging that to deliver high performance. Mm-hmm. So once again, for two parts of that absolute returns allocation, one part, we've looked at what volatility we wanted there, and that was part of our objective setting. The other part, we have a choice in the manager funds. I guess what you were also saying is that most recently, a lot of attention was around those funds that had to deliver. I guess that's a different conversation, but also when volatility spikes, you have to reduce your gross exposure, and whether that's what we've seen happening in March, and whether the managers are just now slower to move back to those gross exposure levels, and whether that's partially reason to the current performance that we've seen. That's also the whole other discussion.
Yeah, that was sort of partly what I was trying to get at, is that you can specify a vol target, but then if the vol is quite low in the broader market, then the fund needs to sort of leverage it up to get the vol there.
That's been the problem for a lot of the managers over the last 5-6 years, since volatility has been pretty much lacking. And suddenly in March, I wonder whether we were ready to see such a spike. But then the problem is that it's not exactly a continuous level of volatility. It's more of a volatility that increased.
I don't think there's any right answer, but it's like one of the problems where you've got this situation where the market regime changes and volatility in those different regimes very different.
And I think the bigger problem for me is not really the fact that we have a manager that runs a volatility of 12 or a manager that runs a volatility of 10. I think the bigger problem, not a problem, but I think a consideration, I should really say, is that whether volatility is likely to be different going forward, and if it is so, how do we adjust for that, and whether we need to adjust for that. That's definitely on the top of our minds and conversations that we are having. I think another thing on a high level that I would want to add there when we talk about volatility is you do need to remember that higher volatility objective for a manager, be it risk premium manager or be it any other manager, would mean a potential for a deeper drawdown. So if you think as any investor, you just need to evaluate that and make sure that your objectives are set correctly and that you can tolerate those sort of drawdowns that can come with volatility of 10 to 15 profile.
It's interesting you sort of talk about within the individual manager, because at the broader case, you're talking about the total portfolio. Should the target vol be almost across that whole portfolio of hedge funds and alternatives?
For our hedge fund alpha book, we have a target for the total portfolios, and then the underlying strategies that we access through hedge fund alpha book would have completely different volatility profiles. Co-investment deals would have completely different volatility profiles to, quant manager that might be in that book. So for that, we're working with top level constraints, and then working with our partner manager to populate that portfolio subject to those top level constraints. With the risk premium side of things at this point, I guess we have a diversified allocation across managers and premium. And to be honest, most of them are along the line of 10 vol products. If you look at it together, coming back to your question, which I've avoided, if you look at it together on the absolute returns allocation, the volatility will be somewhere in between. But once again, on the diversified fund level, the portfolio managers can allocate to one or the other component and using different weights depending on on whether it's an SAA-based fund or a goals-based fund. And I'm probably not going to talk too much about it because that's done on a total portfolio level. But I guess what I do is just to make sure that the strategies that I within my book are managed more like bottom up with objectives of a certain role.
So the final question, what's the expectation of this part of the portfolio, in terms of the liquidity requirements look like?
Without saying too much, this sits in the liquid part of our portfolio. I mean, with the co-investments, we can allow a little bit less liquidity, but given that we have a certain target weight to co-investments, that doesn't create an issue for us.
The reason I asked the question is that some of the funds, the other super funds are using their hedge fund alternate strategies book as potentially another source of liquid funds, liquid equities that they can sort of draw down on.
Yeah. Well, yeah. And I think most of the strategies in the public markets domain, so they're mostly liquid. I mean, if you look at Ultras Premia, that's like the way it's implemented using the derivatives most likely. The instruments are fully liquid, right? So it usually sits in the liquid part of the portfolio. And I've heard of other managers and other investors using ultra-risk premium as the liquidity source in some instances. It's not news. I've seen that happen before. I think I've seen that happen in March again. And then in terms of the hedge funds, they are also, in our allocation, they're also in the liquid part of the portfolio. But I wouldn't want the strategies to be necessarily classified as liquidity providers. I mean, if we needed to, and given that we're moving into a custom mandate, actually, another benefit of that is that you can have enhanced transparency on your strategies and more guidelines in place in terms of how much liquidity you need. So I guess if we really needed to, we could definitely raise liquidity from that part of the book as well.
All right. That's been a fantastic conversation. Thank you very much for your time today, Anastassia.
Thank you, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.